The 10 to 2 year spread just uninverted, and normally this uninversion is preceded by a recession. But with the consumer and labor market looking stronger than ever and the Fed cutting its borrowing targets, could this time be different? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell, let's get into it. Today was risk on. Everything was risk on except Tesla. This wasn't a rotation. This was just buy every stock you could possibly get your hands on. We saw technology to utilities, financials, defensives all perform really well. And this was on the back of some dovish data and sentiment from the Fed. The US cut its quarterly borrowing target to 76 billion. Still record borrowing, but it's 76 billion less than what they had anticipated. And this was mostly on the back of deferred tax receipts coming in from California. All in all, the market seem to like this. It's pretty much saying we are still borrowing at a record amount, but less than what we should have. On the back of this, US treasuries from the 30-year to the 3-month moved higher. Bit of weird action in the 1-month and 2-month treasury. All in all, yields did move higher, but bond prices did move lower as you would expect. But if we dig a bit deeper into the intraday chart, you can see that the TLT from trough to peak on the day was up about 1.3%. Even though prices did move lower on the day as a whole, you got to look at the price action from here to here and actually say, hey, bond prices moved higher and yields did move lower intraday on the back of the quarterly refunding announcement. Let's dig a bit deeper into cumulative fund flow. There's been a lot of buying in TLT, especially as, bond prices have hit these lows right here, and especially in the last couple of months, huge amounts of capitulation. And I think investors are looking at this and saying, we're probably forming an interim bottom in bond prices for the moment. And with what we saw with the Fed and a couple of other data points we'll get through in this video, we could probably say for the interim for the next 3 to 4 months, we probably have seen the lows in treasuries or the peak in yields. Let's move on to smart money confidence, and we can see here that smart money, despite the sell-off in October, smart money is still holding the line. Dumb money has been selling. Very telling right there. So, if smart money does start selling, things could get bad. But based on the price action with what we've seen today, there's definitely some big buying happening, especially with the risk on sentiment that's coming to the market today. Now, looking at cumulative fund flows, and one thing I want to note, this is the price action in October. The S&P 500 down 2.83%, the Dow Jones and the Nasdaq all down upward of 1.5%. But if you actually look at the total fund inflows into the SPY and QQQ have been positive. So people are actually putting more money into the S&P 500, not taking it out, which is contradictory to the price action you would see right here. But where does that leave us with investor sentiment? And we got the sentiment survey, and you can see here that 43.2% of investors are bearish. And this was on the 25th of October. And I want you to keep that date in mind later on in the video. Now we can see that coming into this week, investors were very bearish. Likely so, we did see a pretty brutal red week. But it just goes to show in those moments when everybody is bearish, you need to be bullish and greedy, because we did see a huge bounce on Friday into today. Now, a lot of the poor sentiment right here came in on the back of bad earnings reactions. And we do know that if an S&P 500 firm misses EPS sales or both, they really get punished. Anywhere from 4 to 6% if you miss EPS and sales. That's the daily 1-day return of a miss. However, S&P 500 earnings have actually been pretty good, all things considered. 70% beat rate, and this is very good. 614 beats, 261 misses. Very good stats right here. Now, this is the earnings calendar for the week. I believe McDonald's and SoFi reported earnings, very good earnings. Pinterest too, I think. I haven't looked into it, don't quote me. But we do have AMD tomorrow after close, Pfizer before open. Big companies here. Apple as well on Thursday, PayPal after close on Wednesday. A couple of big healthcare names, Eli Lilly, Novo, Moderna, all reporting this week. So a fairly big week for the S&P 500 this week. But despite fantastic earnings, we still haven't had any record highs. Now, I got some data here for you, and this is the S&P 500 performance after a year of no record highs. The average performance was about 2.3% for that year, but the next year we averaged about 10.4%. And if you actually go have a look at the RSP, this is probably what we've returned for the year to date, including dividends. Does that mean stocks are a buy for next year? This is the forward 12-month PE ratio, the 5-year average and the 10-year average. And right now stocks are below their 10-year average at a 17.1 PE according to FactSet. Very good value. We generally want to buy in the 16 to 17 range. This is where good value is long term for the S&P 500 for the financial markets. But what about stocks versus other assets? the treasury bill yield versus the S&P 500, and as it stands right now, short-term treasuries are yielding more than the current S&P 500 earnings yield. Treasuries are paying you about 5.5%, the S&P 500 earnings yield is about 4.8%. And that means you should probably allocate a good amount of capital to treasury bills, collect the yield. It is risk-free. And if you don't sell, you get your par value back. Let's move on to seasonality. This is the seasonality for this week that we're currently in. So it's the 4-day October to November turn of the month when the trailing week is less than 1%. Pretty much when the last week was less than 1%. This is the 4 days, the last 2 days of October into the last 2 days of November. And here's the stats. Day 1 returns an average of 0.44, 11 up years, 7 down. Day 2, the last day of October, returns 0.18. And the first day of November returns a full percentage point, 16 wins, 2 losses. The second day of November, 0.25% up, 12 wins, 6 losses, for a total 4-day return of 1.85%. What does that mean? It means we're in a very bullish week right now, and you can see your 1% moves or greater, 12 wins, 0 losses. So we are in a fairly bullish week, and we saw that with today's price action, so don't fight the trend. Continuing on with seasonality, this is November market performance stats, 1950 to 2022. The S&P 500 ranked number 1, has 50 up years, 23 down years, for an average return of 1.7% in November. The Nasdaq, very similar, 37 up, 15 down, 1.9% return. Russell, really crazy. Russell 1000, 2%. Russell 2000, 2.3%. Very bullish months for the Russell. Upward of 30 up days, 10 down. Very similar stats right here. And then the Dow Jones, 50 up years, 23 down. I don't really like the Dow Jones because it's price weighted, but an average return of 1.7%. But let's drill down into the month as a whole, and we can see here, this is the November market performance. So this right here is the normal year, and this dotted line is a pre-election year. We normally see a pop at the start of November into the 6th or 7th day of the month. Then we see some fairly muted action all the way to about the 14th, 15th, and then the end of November is when we get the huge rally. Like I said last week, at the October lows, we were buying. I personally said I am a buyer. I have been buying, looking for this pop in November, and maybe around this period right here, if we can sort of like get into the lows, time it pretty well. We'll see what price action does. We have seen that pop. I know it's not November yet, but we have seen that pop into November, and we're looking for a run up close to 3% on the Nasdaq and Russell 2000. And this is what I've been saying for a while. I put this on Twitter on the 25th of October, so almost 7 days ago. Q4 rally to commence if SPX manages to stay above this range by the 11th of the 2nd. At the time, this was the price. I also said bulls need to make a move. We said this on the 27th of October. We said bulls need to make a move right now, and we have seen that move. We have seen some very risk on bullish price action across the whole market. And again, based on this, guys, I want to just get into the charts of the S&P 500 and show you what I mean. Here is the S&P 500 chart. This is the year-to-date chart, and we said that around this level right here, around the 4125 to the 4150 area, this is where we want to see buyers come in. We slightly tipped down below it, but then we saw some big buying into today and Friday. We actually saw a lot of buying on Friday as well, as you can see here by this wick. But let's dive deeper into the day more specifically. So this is the monthly chart. Some very strong buying came at this level right here, a very key level. Then the support. So this became resistance, then resistance became support. We bounced off here. And what I really want to see the S&P 500 do is reclaim the 4,200 level. This right here. I want to see bulls grab this resistance level, break above. I want to see bulls come up here, break above, retest as support, and then move higher into the rest of the week. That's what I personally would like to see, and potentially a close on Friday above 4,200 is going to really bode well for November seasonality. So that's what I want to see in the S&P 500. As long as we stay above this area by November the 2nd, Wednesday, Thursday, around then, we're really going to see seasonality kick in, especially with dealer positive fund flows, charm and Varna flows coming into the market. We've remained bullish for the entire month of August. While everybody was flip-flopping on Twitter, we said that we're gonna stick to the plan, and this was the plan. We're gonna buy weakness unless we close below here. And guys, go ahead and follow me on Twitter, because I do put a lot of stats and statistics and my work on Twitter, which are not on the video. So go and follow us on Twitter, or formerly X, or X, formerly Twitter, 4150 to 4125 by 11th of the 2nd. The plan still remains. If we really do get a breakdown, I'm going to keep you guys updated, and I'm going to say, hey, I know I've sold my positions, but a lot of these positions I am buying are for long term. I am buying the indexes. I'm buying IVV and SPY, as well as NASDAQ 100 QQQ. So let's move on to some dark pools. So there wasn't much going on in dark pools except this right here. This was the QQQ, the Qs, and we saw, again, we saw last week a large trade, the 49th biggest trade since inception, coming at the lows. What do we know? A pop. This trade right here, very, very interesting. You could see 1.5 million shares. Now, I actually went to go look at it. In the book, it's actually exactly 1.5 million shares. And I'm thinking that this is an open position because of its precise size. And also, you can see here that it's in blue. That's a lit exchange. So it's probably tied to options in some way. Whereas these yellow ones here, these orange ones, are dark pool trades. All right. So it's precise. It's probably a buy. Don't think the market makers would short at the NASDAQ at these levels right here. Yet to be seen. Moving on to the QQQ, the ProShares, this is the 2X, this is the QLD, which is the 2X triple Qs. And we saw some big trades happen here and another one at this level right here. And I'm going to say that around probably this level right here, 55.25, if we go meaningfully below it, things could get a bit bad. But if we do go above, test it as support, break above, it's a really good level to look at. So 55.25, key level, we need to be above this in the next coming days. And again, the NASDAQ 100, the equal weight, we saw some big positions come in here. Now, a lot of people will say it's at the highs, could be shorts. Not necessarily true. The equal weight has been absolutely smashed in the last week or so, much more than the actual market cap weighted. Looking at some unusual options activity, two things I want to point out: Meta Platforms right here, as well as Google, Alphabet. One thing we did say last week that a lot of these earnings reactions were probably overblown, mostly because the earnings were actually good. You know, Google grew its cloud business by 24%. The market was expecting 25%. Just crazy. We can now see that the market reaction probably was overreaction, because we could see that Alphabet right here, a lot more calls than puts stacking on the book, as well as Meta, which is 10% up from its lows last week. We could see that Meta is 211 calls to 108 million inputs. Huge overreaction from these two stocks right there in terms of earnings. I do think the earnings were good, and I think they're going to continue to grow. I think they're the two fastest growing big tech companies besides maybe Nvidia right now. I think Meta's going to outperform, as well as Google, and we can clearly see that based on the options activity, those overreactions to earnings was just exactly that, just some overreaction by the algos. Tesla, guys, I think Tesla's going to go lower. I really do. We could see look at the amount of puts to calls. I think Tesla is probably going to go a lot lower than what its price is, and it's definitely going to weigh on big tech and the mega cap 7 over the next, I would say, 3 months. Just my opinion though. And we have the usual culprits, the SPY, IWM, QQQ. Again, always significantly amount of puts to calls. I don't know why. It skews the put to call ratio. Very, very average day, very, very average volume. We've seen that a lot lately. Mondays have seen below average volume compared to the average volume. 50% puts, 50% calls. You would think that based on today's action, it'd be a lot higher. But thank you so much, guys. Please, if you like if you like these videos, give me a like. It costs you nothing. Comment, share this video if you can. Subscribe to me. Hit the notification bell. I love you all. Peace out.